I'm going to start off, and I thank you for being here. I don't know if David Miller's still on there, but it's an honor to come after him. He was my mayor for 8 years, or 6 years, or 7 years. Anyway, as Sarah has said, this is what we're talking about. You can all see my screen, and it's
yes.
Okay, great. All right. So first of all, for those who may not know, the Insurance Bureau of Canada, established in 1964, we represent the property and casualty insurance industries, home, auto, business, and we represent approximately 90% of the Canadian property and casualty market. That doesn't include public auto insurance in certain provinces, but of the private sector market. Today's presentation, it's going to be 5 parts. I'm going to do the first part, the insurance reality, and the last part towards the National Flood Action Plan. And Craig will help me out with the hard stuff in the middle. Okay, so the question is, why does the insurance industry care about all this stuff? And we've been caring for quite a while. I will say that while climate GHG mitigation is very, very important, it's a longer term solution, and clearly we haven't been doing enough. We've been focusing on climate adaptation and resilience because it's happening now. And as you can see, over time, the number of catastrophes defined as $25 million or more have increased almost exponentially since 1983. And you can see the graph here. And what that impact is this is the Canadian chart, is this is in real dollars, inflation adjusted. You know, between 1983 and 2008, we've had approximately $414 million of insured damage. This is insured damage, not uninsured damage, over the years up until around 2008. And we began seeing a noticeable increase in the trend starting in 2019. So it's now on average about $1.92 billion, and the last year was $2.4 billion. Last year was an interesting year because most of the damage was concentrated in two disasters in Alberta, a flood and a really massive hailstorm. We are very concerned because if you look at this trend, it's just going to keep going up. And even the 2019 climate assessment by the Canadian government said that global warming in Canada, the temperatures are going up around twice the rate the rest of the world is. So it's very urgent that we invest in mitigation initiatives, climate adaptation and mitigation initiatives. Now, for Ontario, we've seen a similar rise from about 113 million on average, and it's now about $500 million. Last year, 2020, was actually a pretty good year. We were lucky in Ontario, although earlier this year in 2021, we've had a couple of storms that are I think are adding up to already in the first 2 months about $100 to $150 million. We tend to be a slightly less than our share of population than the rest of the country, and I'm going to go out on a limb. There's a couple of reasons for that, but you know, our geography may be better, but also the work that's been done on zoning and conservation authorities. It's been so cost effective, and I think it's avoided a lot of the problems. Nevertheless, we are seeing this increase, and a significant amount of it actually is from sewer backup and that sort of thing when we have these flash storms with infrastructure that was outdated, and that's part of one of the things we're advocating for. Now, this is what the federal government pays out, or is estimated to pay out, up to $900 million a year, 75% caused by flood, for essentially uninsured damage to help provinces and municipalities. Most of you may know this, but Ontario, because of the formula, doesn't get what I'll put in quotes, the benefit of this DFAA, Disaster Financial Assistance Arrangement, because of our size and population and the way the formula goes. But this $900 million a year, but used to be a lot of money. These days it seems a bit less, but it's still quite significant. And we think this is going to rise over time if we don't adjust. Now, I'm going to hand it over to Craig to take over this section of the presentation.
Hi, everyone. Thanks, Arthur. And thanks, Malik and Chris, for the invitation to present today. You've got such a terrific lineup that you have over the 3 different periods, the 6 different sessions. So congratulations on pulling together such a tremendous agenda for the asset management community, not just in Ontario, but nationally. So I'm going to pick up from Arthur and translate what you've just seen in terms of those rising, escalating insurance losses since 2009. And what we're seeing and how that's translating is essentially into a hardening commercial insurance market in the country and escalating insurance premiums. And federally, that is translating into a review of those disaster financial assistance arrangements. So essentially, after a decade of those mounting losses, what we've seen is a few global insurers are pulling out of the Canadian market or have pulled out of the Canadian market. So that has affected insurance supply in the country. Secondly, the cost of reinsurance. So that's the insurance that insurers purchase in order to, in a way, backstop their losses. That the price of that reinsurance globally for Canada has gone up. And that is expected to rise because, as Arthur said, and as we've heard from Environment and Climate Change Canada, Canada is warming at twice the global rate. Insurers price risk. Canada is a riskier place for insurers to do business. So we are seeing overall changes in the marketplace as a result. In addition to that, because of the mounting losses that frankly were unsustainable for the disaster financial assistance arrangement federally and similar programs provincially, several of these programs across the country, including the federal program, are currently under review. And there's conversations ongoing now, actually like in earnest, about how do we come up with a better way, a better system, better public-private partnerships to share the risk more effectively, especially for those who are in higher risk communities across the country. And Arthur's going to speak to that a bit more in a minute. You've already heard from Chad Nelson at Infrastructure Canada about resilient infrastructure. So why infrastructure, how the federal government is viewing climate resilient infrastructure. I'm going to speak a bit more about infrastructure that provides resilience functions. So that's everything from stormwater management upgrades, new diversion and retention facilities. Obviously, in our view, in order to lower that risk that Canada is facing, we need better, more thoughtfully placed, strategic decisions around defensive infrastructure in communities across the country. We have recently, the conversation has turned to how do we leverage private sector capital. At this point, for the shifts that Mayor Miller described, a lot of that with regards to carbon reduction, a lot of that can be funded through public-private partnerships leveraged by entities such as the Canada Infrastructure Bank. But we're not seeing, so in the decarbon, reducing emissions space, whether it's with building retrofits or investing in electrification or new LRTs, private sector can play a role there because they are all revenue generating projects. But in the resilience space, you're not seeing private sector money flow in. Why? Because it's very difficult to translate that reduction in risk into a revenue generating instrument. We haven't figured out how to do that in this country. We haven't figured out how to do it around the world. But there are efforts underway right now that insurers are leading, particularly with the government of the UK. Canada is a participant, and it's called, the particular coalition is called the Coalition for Climate Resilient Investment. And they're trying to crack that nut. They're trying to figure out, okay, can we come up with more new financial instruments that take that cost avoidance, the savings that are provided when you conduct stormwater upgrades or when you introduce a new diversion or retention facility, and can we translate that into some sort of revenue generation in a way that would attract private capital? And so stay tuned. The conversations are well underway, and the financial sector is co-leading them, but we're not there yet. Which brings me to natural infrastructure. So the same issues we have pricing traditional infrastructure upgrades challenge us when it comes to natural infrastructure. As you likely know, there's a fair amount focus right now on climate financing tied to natural infrastructure. Whether it's, pricing the carbon sequestration value of natural infrastructure, bringing in offsets where you take advantage of carbon markets in order to value infrastructure, the offset value of infrastructure. But where we're focused, not surprisingly, is on the resilience value. How do you price the resilience value of wetlands, let's say, or sand dunes in coastal community for the value that they provide in protecting communities? And then how do we leverage such pricing to incent the conservation or the restoration of such natural features? So I'm going to get into this in a bit of detail. Next slide, please, Arthur. So, and I'm going to use it with reference to a case example, which is the City of Ottawa. So the City of Ottawa, as you know, probably alongside Fort McMurray, are the two poster childs of climate change in the country and climate losses in the country. The City of Ottawa has experienced 2 significant flood events and an F3 tornado in 3 years, which have driven significant losses and frankly has strained the fiscal capacity of the municipality. The municipality, if you talk to the councillors for West Carleton, he has said, if we hadn't amalgamated, frankly, and we're backstopped by the city, the previous municipality, West Carleton, would be bankrupt by now because of the losses that they've faced. So what we have done is we're in conversation with a number of municipalities across the country, but in particular, we're focusing in Ottawa because it has all of the right ingredients. It has the natural features upstream in terms of wetlands that really mitigate risk for the city. It has, it's motivated because it has witnessed recent events. And so we're zeroing in on what sort of solution could we put in place that would price the value of that natural infrastructure and tie it to insurance contracts that would effectively reward the existence of that natural infrastructure upstream. So I'm going to walk you through that case example to help get to help folks get their minds around it. And I should give a shout out to the Municipal Natural Assets Initiative. I think Michelle is on the phone or on the call here. MNAI, we're really lucky in this country to have an organization playing such leadership in this space, and we relied on MNAI as a convener, but we'll be relying on their expertise going forward with regards to the pricing expertise that they have. So I'm going to give you just a bit of very quick primer on parametric insurance. So you're used to what's called insurance indemnification insurance. So insurance that provides, a reactive solution to be able to post-event pay for the losses that were incurred by the event. Normally, you need some sort of appraiser to come in, take a look at the losses, take a look at what damage was done by a severe weather event, and then a payout is done based on that damage. A parametric approach is very different, and it's evolved in the developing world where it's not easy or practical to bring in appraisers, and where there is often a need for funds to flow very quickly to ensure social stability, get water running and the lights turned on very quickly after an event. And so it has evolved in that milieu, but it's now being deployed in more advanced countries because of the benefits it brings. So in this case, the insurance relies on a measurement of a natural phenomenon or index. So it could be flow rate of a river, it could be wind speed, it could be a certain amount of precipitation. Once that has been triggered, once the parameter has been passed, based on the insurance contract, the payout is automatically made. So there is no bickering about, how much losses have been incurred. It's basically very black and white. As soon as you hit a particular wind speed, the losses are then assumed, or a certain flow rate of a river, or a certain precipitation amount, et cetera, or it could be applied to an earthquake with a certain magnitude. The payout is usually made within 14 days, and it can be used for any purpose. So it essentially the buyer of the policy can then take it and use it for whatever they wish. The next slide, please. Oh, Arthur, next slide, please. Yeah, thank you. So that said, there are three elements that are needed for a nature-based insurance solution. You need to have a good understanding of what will endanger the asset. You need to have a good idea of what the mitigator is, what keeps that asset safe. And you need to have a good idea of the asset itself. What are you trying to protect? Next slide, please. So here's a case example. The government of Quintana Roo in Mexico purchased a parametric policy that factored in and priced the benefits of the Mesoamerican reef offshore in protecting hotels, beach sand, and therefore tourism revenue that flows to the state of Quintana Roo. In that case, the threat was a strong hurricane that could destroy or damage the coral reef, could damage the beaches, and therefore could damage tourism revenue, because the quicker that the tourism revenue, that the beaches were offline, the hotels were offline, the greater the losses incurred with regards to revenue, taxation revenue. The mitigator were coral reefs. Coral reefs actually reduce as much as 97% of a wave's energy and protect the actual beaches on shore. And so they wanted to incent and price in the value of the coral reef into the insurance contract. And the asset, of course, was the tax revenue at the end of the day. So they set up a flood management trust, basically a management trust that would do several things. It would allow for the coral reef to be restored with payouts should a storm affect the ability of the coral reef. It allowed the hotel operators to restore beach sand, replenish beach sand, and it provided Quintana Roo the flexibility to apply the funding in any other way that they felt necessary post-event to preserve their revenue. And this was no sooner was this in place than a hurricane, of course, did strike, and that was last year. Hurricane Delta did strike. The wind speed parameter was surpassed, and the insured, which was the Flood Management Trust, received approximately $800,000 in payout to restore the reefs and the beaches. Next slide, please. So how does this compare to Ottawa as a potential case study? So Ottawa actually already has a insurance cover to protect a public infrastructure in the case of a severe weather event. And a parametric approach could be used in the renewal of such a policy. They also have an emergency response budget, which has been strained, and further public infrastructure that they've identified through their recent review. And these budgets are affected by these increasingly expensive natural catastrophes. Meanwhile, the wetlands, which are actually within the Ottawa city limit, but administered by the conservation authorities upstream, are under significant development pressure. So those wetlands, if developed, will erode the flood protection for the city of Ottawa by roughly 10%, according to the conservation authorities. So what we ideally would do, and what the conservation authorities have identified as a top priority, is to acquire the wetlands, which are on developed lands. And particularly the Goulburn Wetland Complex, which is near Stittsville. And what we're trying to guard against, the threat, is the spring flooding that is occurring, the spring freshets that is occurring and has destroyed public and private infrastructure and depleted city budgets. Next slide, please. So here's the complicated solution, how this all would work. And this has been developed by Swiss Re, who is the reinsurer that currently holds the city cover, and was the same one that pioneered the concept in Mexico. So in this piece, the Flood Management Trust sits at the center of the diagram. So, and the idea here is that the Flood Management Trust would receive funding from interested parties, and in particular from the Disaster Mitigation and Adaptation Fund, which is hopefully going to be renewed in the next federal budget in a month's time. And we've been in conversation with Infrastructure Canada around the design of the DMAF program to make sure that it can be used for these sorts of projects. So in this case, provincial and federal governments would ideally contribute to the Flood Management Trust, and with funds specifically designed to acquire the wetlands and ensure that they're protected in perpetuity. Resiliency partners would administer the wetlands, and in some cases, if for, let's say, private businesses, hydro authorities, for instance, would provide ideally also an investment contribution to the Flood Management Trust. The funding would be used over time also to maintain the wetlands if the wetlands are damaged, either through a natural event or through human use. The City of Ottawa plays a key role, obviously making not only an investment contribution, but paying for insurance, the premiums for an insurance policy, and corporate partners ideally would also pay for that because they would be beneficiaries at the end of the day. And then a premium payment for a parametric policy would go to Swiss Re, and Swiss Re would provide that financial resilience and funding after a major event back to the trust, which would then administer the funding and flow it back to the different beneficiaries. So that's the way that the model, the proposed model would work. And this is what, for example, we are in conversation with Ottawa about, and would be happy to explore. If you have any questions, feel free to reach out to me through Chris, and we can go into a bit more detail. Next slide, please. So now we're going to zoom out from natural infrastructure and from a very specific solution to talk about how we're partnering with governments across the country on the primary climate challenge that we're facing in this country, which is flooding. So Arthur, I'll turn it back over to you.
Okay, thank you, Craig. So quickly, there are 4 million private residences in Ontario, and 16% are considered at risk of flooding, and I'll show you what that means in the next slide. And about 360,000 of them are at high risk of flooding. So what does that mean? So as part of, we're going to talk about the National Action Plan on Flood, but the 1 in 100 here is what we considered high risk. That's another way to put it is over a 25-year mortgage period, for example, there's a 25% chance of a flood happening. And in that case, what we're going to talk about in a bit is the way to address this, in our view, is to create a high-risk insurance pool that could provide more affordable insurance that otherwise might not be available in the private market. And it would require retrofits and or some sort of mitigation funding that could be provided with assistance from the government. Now, 1 in 20, part of the National Action Plan on Flood, that's a very high risk. And to deal with that, it's what we call strategic retreat, which is if there's a problem or a disaster, the incentives would be created that instead of rebuilding the place where you are, that you would be given some compensation to move to another area. It also could include retrofit if it's possible, depending on the circumstance. And another way of doing it is infrastructure upgrades mitigation. And then over here, if you have a if you have a lower risk, greater than 1 in 100, you would rely on the private flood insurance market, and that still would be hopefully the vast majority of properties. So as part of the National Action Plan on Flood, we've been advocating to the federal and provincial governments across Canada. As a key component of it is education and awareness, and that requires we believe launching a robust consumer flood portal based on accurate flood mapping and reliable information. And for the government, they should be investing in improving the quality of the terrain data, that it will be the foundation of the flood mapping. And there is activity on that, but it's taking longer than we would like. And finally, I think we need to bring in the financial intermediaries when it comes to properties to have access to these flood portals to maximize engagement and understand their risk a lot better. So I talked about relocate and protection for the very high risk flood zones. This would require financial assistance as part of the National Flood Plan. Right now, well, I'll get into that in a bit, but there is a task force at the federal government that is examining these issues. One of the key things, secondly, is targeting priority infrastructure investments in the highest risk areas to protect as many people as possible. So we are asking for an increase in disaster mitigation funds. And as Craig mentioned, we're hoping to see more of that in the federal budget. We're asking that of the provincial governments too. It is quite expensive, but we think it will pay for itself over and over again, just like some of the investments we've made 50 to 100 years ago. And then developing high-risk insurance pools for residents in high-risk areas, which we mentioned. Here, I think we're more advanced in Ontario on land use rules because of conservation authorities, Hurricane Hazel and all that, which many of you will know about. But across Canada, going forward, no home built on a floodplain should be eligible for disaster assistance or affordable insurance. They'll either have to the insurance won't be available, or they'll have to relocate. The private market won't be able to take care of that. provincial and municipal governments should adopt improved building codes and standards, which take a long time, but they slowly evolve over time, and they have evolved in the right direction. And finally, to wrap it up, the IBC has been very busy creating lots of policy papers and solutions, and these all can be found on our website, and you can see them here. And we would appreciate it if you'd, we'd love it if you'd come and you had some spare time to read these.